What about Zoom, the pizza company?
Oh.
Like literally from day one. So, okay, on that company, I met a guy who invested in that company early, or relatively early, and it was a data-driven VC. And I was like, what data do you have for this company? And he was like, we have all this data on like number of shares on Facebook of this video about them. And I was like, why the fuck would you invest off of a shares on Facebook shares on a pizza company? Like people were sharing this video about this pizza company on Zoom because it's like a robotic pizza company, and they used that as input to invest. And I was like, that's crazy.
And then they told SoftBank about that one, and they heard you're investing. They didn't even hear the shares. They're like, done, boom. Sheel, I am so excited for this. We get to do this in person, baby.
It's amazing. I'm stoked.
I mean, listen, you are so much better looking in person. But first, I want to start with a little bit on you. And for those that missed our first show, so how did you make the foray into venture in a very succinct 2 to 3 minutes?
Yeah, sure. So I had always wanted to be in business. Like it's in my blood. For those Indian people, I'm a Rajasthani, and I didn't know what to do, but I always was tinkering with ideas as a kid, always had a bunch of small businesses. Then I went into the corporate world. I was a management consultant. Then a buddy of mine was leaving to start a company, a fintech company, payments company, and I joined him. And then we sold that company in 2012. Then I ended up starting a company that we sold in 2015. And then at that point, I thought, hey, I've really loved what I've seen on the other side of the table. Like I've loved what I've seen from VCs interacting just when I was fundraising. And man, aren't they the smart ones is sort of what I was thinking. And of course, now I know better. Like now it's the other side of the table. It's the founders that are the smart ones. But it's possibly just like anyone across the table from me is smarter than me. So that's just how it works.
I don't think that's true at all. But I do think that we change so much as investors. And I'd love to hear if you could go back and call yourself the night before your first day as a VC and say, you should know this going in. What would you say to yourself on that call?
I would say like no one knows what they're doing. And so
do you believe that?
I do.
Really?
I feel like the more I've gotten into it, the more I've learned. There's no right way to do it, right? Like there are so many different strategies that can be successful. People can be very prescriptive and say this is the only way to do it, or this is the only way to do it, and you can have that. You see that in so many different arguments. You have that in like we were talking about the remote work argument. So you can say the only way to do it is 5 days a week in person, and if you don't do that, you can't be successful. But there are clearly companies that are successful that are remote. Mm-hmm. And now it is actually my preference that companies are in person, but I can't mandate it. I don't mandate it because I think we've seen too many success stories that aren't all in person.
I totally agree with you. I don't know, I sit down with your Bill Gurleys of the world or your Pat Grady's at Sequoia,
yep.
And you're just like, they really fucking know what they're doing.
They do.
And so I'm just like, do you know what I mean? And so I've kind of pushed back on that because I think it's an easy trope to be like, oh, no one knows what they're doing and it makes us feel better. But no, they do. And actually, that's often why they continuously have the best returns.
So I'll push back on that. So with Bill Gurley in particular, let's say, Pat, I haven't spent much time with recently. But so with Bill, I was talking to another one of his partners about their meetings. And they actually had been talking about something I tweeted. And he said they had a rigorous internal debate about the right way about what was correct, and they don't know. Like they couldn't come to a conclusion about what was right. And I think it's like there are ways that you can invest, but actually knowing what to invest in or what a mode is, I think people are still figuring it out. And even if you look at the greats, they have a bunch of misses, and they have a bunch of companies that you say, like, why did you do that? It didn't make sense in hindsight.
I totally get you. You mentioned, I mentioned Bill Gurley and Benchmark there. And Benchmark are kind of famed for their discipline on fund size.
Totally.
Now, you said before that fund sizes should get smaller.
Yeah. I think...
Go.
So... I think we are operating in a crazy prisoner's dilemma situation where there's a bunch of capital that wants to go into venture still. And if you increase fund sizes, the industry as a whole needs to return a lot more than it probably will. And so if everybody reduced fund sizes, then we would probably be operating at a different level. We would be investing at lower valuations, and it would probably be better for everyone. instead, we've got this continual upward march of fund sizes. And when you have a bigger fund size, you become relatively agnostic about the price you pay.
So if we just like break that down before we kind of move further in that argument, do you think that actually LPs are still in market? You hear continuously about funds that are struggling to raise, whether it's the large kind of $20 billion PE firms or actually it's the much smaller micro firms. Across the spectrum, people are saying LPs have withdrawn or retreating in the last year.
Yeah. I think there are LPs that have withdrawn quite a bit, but then you see everybody's in Saudi Arabia right now. Right?
I want to start a startup that does like shuttle service to Saudi Arabia from the valley.
It's insane.
Yeah. My favorite thing is actually the hypocrisy. I'm going to get in so much trouble for this.
Totally.
The hypocrisy of, we would never take money from there. First fucking recession comes, they are there.
Totally. I have no strong viewpoint about it, like about whether you should take money from there or not. We haven't, but I think it is very hypocritical that all these folks who were anti-Saudi money are now over there just praising everything.
Totally. So we have that on like the LP side, agreed. We do have funds that are starting to reflect what you say. Like Founders Fund halved theirs.
Yeah, exactly.
Like, do you think we'll see more?
I think we'll see more. I think we have to. I think
why
founders,
would managers do it? If you think for them it's a loss of fees, like it's not in their interests.
Well, it depends. If you're fully returns focused, it could be in your interest.
Could be.
And I think a lot of the large funds have gotten so large that they're really more management fee focused than they are returns focused. But I think for the returns focused funds, and like if you talk to Founders Fund, that's what they say was the reason they did it. They felt like 1.8 was too big. They wanted to go to 900 because they wanted to stay focused on returns, and they felt like that was a better size.
Do you think we'll see funds give back funds?
I don't know. I don't think so.
Yeah.
I know that that's happened in the past. I just don't see it happening this cycle. And probably if it were to happen, it would have already happened.
I agree with you totally. Can I ask, how big's the latest BTV fund?
So we're a $150 million seed fund and a $75 million opportunity fund.
I was with an LP last night, and they said that when you do outcome scenario planning on a $150 million seed fund, where I actually said $125 million, and they were like, way too big, way too big. How did you feel about your fund sizing on that?
Yeah. So we went from 75 to 150.
Yeah.
I think for us, it was more about like, how many checks do we want to write? What's the size of those checks? And what's our follow-on strategy? Yeah. Now, we raised over a year ago, and part of it that I think, part of the reason we increased was in Fund 1, pretty much every one of our companies raised a follow-on round quickly after we invested. Yeah. And we were almost forced to do that follow-on round. If you lead the seed round and somebody good is following on, you kind of have to follow on. Yeah. And so our first check to follow on strategy was totally out of whack because we didn't have enough data, but you have a great fund leading the next round at a huge markup.
Do you have to? Can you not do the strategy of, hey, you know what, we lead and then we're totally aligned to you and want the best for you, but we don't actually write anything beyond our first check?
You can do that. I think for a fund like ours, it doesn't really make sense I think for a lead investor, it doesn't really make sense because what ends up happening is some companies need more capital and like not the ones that are killing it. The ones that are killing it are able to raise easily. But there are other companies that are doing well but need a little bit more capital and you have to put more money into them. And they're doing well but not well enough to raise the next round. Yeah. And we've had companies like that ended up being super successful. Actually, one of the companies recently, we led a seed and then we put a little bit more money in like 6 months ago, and then they just raised at $100 million valuation from Andreessen. And we're really fortunate that we put that little bit more money in. And I think if you don't do the follow-ons, like if your strategy is just to do one check, but you have to do some follow-ons, then you end up not following on into your best companies. You end up following on when you have to, which can be your worst companies.
I think follow-on is actually just an inherently hard strategy because it assumes that you can essentially predict your winners so much sooner than I think you actually can. I think me and you have both been in this long enough where actually my winners are ones which I would not have put as winners first, and my winners are definitely not winners.
So I think that's true, but you do know your losers.
True.
So I know companies that I don't want to invest more into because, the founder doesn't have a sense of urgency or like.
But actually, the losers are the same as the slow burners that go nowhere to a 0.5x to a 1x, if we're being honest.
Yeah, I would say there are companies that I've had where I just know like there's very little chance I'm going to put more capital into it.
Do you tell them then?
No, I think it's like...
Because it's hard. You don't want to like burst the bubble of confidence and, hey, by the way, you're struggling and I'm not going to give you any more money. Oh, thanks, Sheel.
No, I wouldn't. So no, it's not necessarily that. Sometimes it's like the market hasn't developed the way we thought it was developing.
Yeah.
And there's an opportunity to pivot, and sometimes they take that opportunity and sometimes it works. But if they don't do that, then there's little chance that I think the market is going to develop the way we thought it originally was. So for example, we invested in a company in Southeast Asia that we were betting on the fintech market in Southeast Asia getting much bigger in a way that hasn't really developed. So then we have to think about, okay, unless they pivot into serving a different type of customer, we can't continue to support them.
Yeah, I totally get you. You mentioned Southeast Asia there. We both did forays into emerging markets.
Yeah.
We've spoken a little bit before on email, actually, before this about kind of the death of fintech. I think first is like the death of emerging markets. In a macro downturn, everyone fucking pulls back.
Totally.
More than ever before. Is emerging markets investing pretty dead?
It's struggling for sure, I think. And the more emerging you go, the tougher it gets.
Yeah.
So in a low interest rate environment, money's free and you're like searching for like more risk and you go to emerging markets. And a lot of people invested in a lot of places that they'd never been, didn't know much about. And I think now people are coming way closer to home. But I still think there's opportunities in emerging markets, and we still continue to invest in emerging markets, but probably less the like really far out markets.
What's the really far out, just so I understand that?
So I think people have invested a lot in like Pakistan, Bangladesh, parts of Africa. I think they will continue to. Like there are still good companies in these markets, and the great companies will continue to raise money. But I think what had happened was, there are a handful of great companies, and what had happened was a lot of people who had never invested in these markets before started investing, and then instead of just putting money into the handful of great companies, like the 100 companies after them that weren't that great also raised money.
Sure, but even the handful of great companies, if you do not have a liquidity mechanism to get cash out, even if it works, go to Pakistan, go to Bangladesh. Where are you going to go public?
Totally.
Are you going to come to the NASDAQ? I don't think so.
Yeah, I think, first of all, I think it can happen. It's tough. But for a truly great company, there's always going to be an option.
Is there an example of that?
I mean, in Africa, we've had liquidity. We've had companies that went public. And
on the NASDAQ or?
Yeah, I think we've had companies that went public on the NASDAQ, yeah, from Africa. And you could always have made that claim about LATAM, and then we had companies, we have Nubank, super successful company. So you could have made these claims about different markets that ended up maturing and building a robust market. Now, what happened that I think was totally shitty in 2021 was you weren't getting an appropriate discount. Yeah. So if it's going to be a really tough path, but you have an exceptional founder, there's going to be a path to liquidity at some point. But you have to get in at the right price to account for that. So,
and we were paying prices that were akin to developed markets.
Yeah. People started paying like seed rounds at $20 million valuations, and in a market that's going to be a really tough path to get to $1 billion plus exit. And that, I think, was a shame.
You said there about kind of Nubank. That's kind of it. There's D-Local, which is like a $7 billion company.
Well, now it's probably a lot lower after that there was a short seller report. I think it's like a few billion now.
Okay, we had Seba on the show, so, maybe I wanted to be nice, but, wherever they are, Seba's fantastic. Seba, I still love you.
No, you've had others, Mercado Libre. And
Mercado Libre is a great one, but there's like two or three.
Yeah, there aren't that many.
To build a firm on the back of that, for sure, would be horrible. A tough sell.
Totally.
For you, when you and Jacob sit down, do you guys go, shit, we're going to have a lot of hungry mouths to feed in emerging markets?
Yeah, I think there is some of that, and I think we're probably more focused on the U.S. now than we were 2 years ago, like a lot of folks.
I get you totally. Is it more focused on the U.S. now than...
Or It's U.S. and like non-emerging markets. So like Israel.
You mentioned 4 companies in London. I was bluntly a little bit surprised by as many as 4.
Yeah.
How do you guys think about Europe?
I think so. Some of the companies we've invested in here are actually not serving the local market. So, one of them is a company that sells into banks globally. One of them actually sells primarily in India, and then we have a couple that actually none serve just the local market.
Okay. Are you impressed by Europe? I think it's that, bluntly, we've seen this massive attraction to Europe and zero interest rate from the US. And now most have retrenched. Lightspeed are here, GC are here, and Sequoia are here because they all opened offices here.
Yeah.
But the rest who did the pit stop tools are not.
Yeah. I think there are great founders here. I think the ecosystem has developed. I think like for a while there wasn't the ecosystem around it. And like now you've had a lot of folks actually move from the States here.
Yeah.
And there are good companies getting built here. And so I'm still excited about it. I think there are a lot of companies, the companies that I'm most excited about are building here, but for a global market.
I feel like you're holding back on something, Sheel.
No.
No?
I just think like I haven't done anything that was purely serving the local market.
I get you. I had a guest on recently, actually, and they said that Europe's the hardest market because it's big enough to keep you busy for a couple of years, but not busy enough or big enough where you have to go big from day one.
Yeah,
which is really interesting.
It's so true, and that's why I've invested in companies that are global from day one.
Yeah, no, I totally get you. Okay, so we mentioned geography there. Obviously, BTV has a big fintech focus. It's not AI, is it? I mean, let's just be honest.
Everybody just pivot to AI now?
Why not all AR? I feel this is happening.
Starting last week, everyone's going to AR.
My favorite is the way we shit on these companies. Like, Facebook's so far behind Google. So Google with AR is so far behind. Who are these guys? Release Bard. Everyone's like, I knew they were coming. I knew they were coming. But same with Apple and AR. It's like, what are Apple innovating on? They do it. It's like AR. Question for you though, like, how do you think about, bluntly, the negativity towards fintech today?
Yeah.
And respond to that.
Yeah, sure. So I'd say, like, stepping back, I started investing in fintech exclusively beginning 2016. And I think, like, what drew me to it then was it's a huge part of the economy. It's like financial services, 20% of global GDP. And it's a digital thing. Like, it's numbers, it's money. And so it should merge with technology. Like, just from a macro perspective, that all makes sense to me. And from 2016 to 2021, there was this like crazy upward slope of trajectory of fintech companies. And if I'm being honest, like 2020 and 2021 were just like overhyped. And that upward trajectory, like that chart of e-commerce, like it went up and then it went like crazy hockey stick and then it went down, but it's still continuing on that same trajectory. So I don't think fintech's dead. I think we're just back to where we were a few years ago.
Is it better for you now because there's much less competition?
I think so, yeah. I think there's less competition, so less competition for capital, but also less competition for companies. So in 2020, 2021, every company we funded, there were 5 companies just like it, also with great founders, with great investors. And so what ended up happening is a bunch of capital went into these companies, and 5 companies serving the same customer set. That's a lot of competitive pressure, and nobody makes money because you're all price competitive and you're all serving the same customer set that now is comparing against others. I think now we're in a much better place, and the people that incremental founder that was building in fintech because it was cool is now building a Gen AI tool, and that's great. And I think I still feel.
Do you mind the founders that hopped from trend to trend?
I don't mind it actually. Like, I think like Gen AI is super exciting. And if you're super excited about it, build for it. Like, there's no reason I should be prescriptive about what you can and can't build. Like, it's really exciting.
On the venture side there, when we think about like next 10 years of venture, how do we think it changes? We mentioned Andreessen earlier, we mentioned Benchmark. How do we think about like what venture looks like in the longer term and who the winners and who the losers are?
Yeah. Well, right now it seems like we have these like super big funds, right? We talked about Andreessen, General Catalyst, all these other guys. And I think those guys seem to be in the AUM accumulation game.
Yeah.
And I think it's tough. It's it's a tough business to have. Like if you think about these huge funds, just getting returns on these huge funds is really tough.
Yeah.
You're really only shooting for $10 billion plus outcomes.
100%. And even then, it's not enough.
And then I don't know how many of those there are going to be.
But if you actually project it out, your NEAs as well at $3 billion, you have a $10 billion outcome and you have 10%, which is pretty good, 10%.
Pretty good, but doesn't return your fund.
No, it's a third.
Yeah. And I don't know how many $10 billion outcomes they're going to be. Like, if we're honest, like in 2021, it looked like there were a ton of them. And now those companies aren't looking so hot. So I don't know how often there's going to be a $10 billion outcome.
So what happens with those funds?
I think it's tough. I think they have to shrink if they want to be returns focused.
Do they, or actually do they just move into a different class of LP? Because now they've moved away from your family offices,
Totally.
Even university endowments. It's like, bluntly, the biggest of the biggest sovereign wealth funds who drop $1 billion in.
Totally. And yeah, but like those guys also at some point want returns.
Okay, have you spoken to those LPs? Because you know what, they don't actually care.
That's probably true too.
And it's like such a small drop in their bucket.
It's
They're
true.
like, you know what, we're in Andreessen, tick the box on venture, move on to where we really make money.
Yeah, maybe that's true. I mean, they dropped $45 billion on the Vision Fund.
Yeah.
Which is insane.
And it's still pretty small for them.
Still pretty small. Yeah.
Right? So I'm not okay. So we have.
So one thing I'll say is like when we started, Jake and I said we don't want to be in the asset accumulation game. Like we want to be returns focused. So in that vein, we actually don't pay ourselves as much as we could. We actually don't even take full management fees. We have.
Sorry, can I? What do you mean you don't take full management fees?
So now we have 300 million AUM. We could take 2%, which is $6 million, to run our business. We actually take a much smaller amount and return it to LPs.
Why?
We just wanted to be returns focused, and the more money we have to invest, the better.
So I would argue, and I'm being deliberately divisive here, but I would argue that's short-sighted because you can invest in your firm at a much more efficient rate that will deliver outsized returns with that $6 million.
So we think we're investing as much as we want. We like the lean team. We have 7 people. And we think we're doing everything we want. So we don't need... And like the reality is most other managers, it's not actually investing in their firms. It's like if we wanted to, we could take a $2 million salary each and that's $4 million bucks. And then we still have $2 million to invest, right? In building the firm. And that's actually a lot of money. So instead, we're not like... We don't want to be fat and lazy. Is basically what it comes down to.
I think a lot also spend money on like VC value add services, which then they can use and sell to get subsequent LPs. We have talent managers. We do. Community directors.
We have a talent manager.
Okay, interesting.
And he just helps our companies with hiring.
Okay, wait. Do you believe that these venture value add platforms actually add any value?
I'll say definitively that when
they do not.
No. I'll say definitively is that. So we recently won a hotly competitive deal. And one of the things that they told us about why they chose us was so many people spoke highly of our responsiveness and catering to their needs. And a big part of it was actually like we've landed several high quality candidates into our portfolio. And they were like, this is the hardest thing. And these guys have helped us with the hardest thing that we have to do, find talent.
That's so interesting.
But generally, I've heard the same thing where people say, like, it's all bullshit.
It's all bullshit. And, like, actually, like, so I'm sure your talent person is amazing. But it's so different hiring a head of a developer relations versus a CMO for a consumer brand. I think, actually, it makes much more sense in your world where you're working Fintech. In a very thin slither. Like, the actual hire spectrum is much smaller than e-commerce fulfillment and then, like, deep infrastructure Fintech.
Totally. Well, so Yoni, our head of talent, like, he's been recruiting Fintech people exclusively for the past 9 years. And so, like, this is what he does. And he recruited, at NerdWallet, he did, like, every end of the spectrum. He recruited every different type of person. And so he could do the same in our portfolio and has done.
What do you think are the biggest misconceptions about venture?
Oh, man. I think a lot of people think it's like a very easy, cushy job. But I think especially when you're starting out, it can be very tough. And I think there's a big divergence among managers. Like, it can be an easy, cushy job at some of these big funds. But I think, like, for the manager that's just starting out, it can be tough, and you can be investing more into it and not getting paid for quite a while before you end up.
Oh my God, absolutely. I remember with our first fund with Stride, whatever the fundraise process was, but it was a significant, 12 months or whatever it was.
Yeah.
Of course, you have no salary. Like, it's a very luxurious position. I was very lucky with the media company, but not many people can just go a year without salary.
Totally.
And then fuck GP commit.
Yeah, exactly.
Everyone's like, you GPs, you're like, fucking hell, have you seen how much I'm putting into this?
Totally, exactly.
I'm getting debt on my fucking...
Exactly.
Unbelievable. Talk to me, on the first fund, did you have an anchor?
No, we had no anchor. So there was Fund 0, my $15 million fund, then Fund 1, 75, and we had no anchor in the $75 million fund.
How did you go about that, man? Was it friends and family first? Was it institutions first?
So our first close was mainly friends, like people who knew us in the fintech ecosystem who were willing to back us just because they'd seen us in the ecosystem. And then we had one institution, was Sandana.
What does that get you to? Like the friends and family still there?
Yeah. So it got us to 18 million.
18 million.
And it's no family. Families have no money.
Give you $10. Yeah. Mine gave me an invoice, but
yeah, exactly.
You called me as $28.
Yeah, exactly.
So they took you to 18. That's good.
It was good,
but it's not near enough. 75.
Not near enough. So, but we hit Sandana in the first close, which was wonderful.
Okay.
And then
do they help a lot having an institution like them? Or?
I think it gave some credibility.
Yep.
I think like also just having a first close gave a lot of credibility. Like, and we'd done our first investment. So like we were investing, and we'd had a first close.
How big did you do for the first close?
18.
Oh, you did 18. That is a really early first close.
It's an early first close. Now, part of the reason we did the first close is we had a company that we had to invest in. We had committed to this company in like September. We said, we're going to lead your seed round. But we actually didn't have a fund at that point. And so we had to close as soon as possible so we could fund that company. And I think you, it's the company was Unit, a banking as a service company.
Yeah,
exactly. Yeah.
Fuck, you did that?
Yeah, so, and it was amazing because that company has been super successful. Like they're, I think the winner in this banking as a service space.
Dude, can you imagine not having done that?
I know.
Oh, God, that is such a good company. I really like Itai.
Yeah, he's amazing.
Yeah. Okay, so you closed on 17, 18 there. Was that right in hindsight? Like, would you advise managers just close as soon
as possible? Like then LPs can take you seriously because you have a fund and you're investing.
But true, but then how much was that first check into Unit? Because if you close on 10 and you want to do 75, if you committed to lead a seed round with 1 or 1.5, you're putting 15% of what you've raised out the door in the first go.
Yeah. No, I think we did a first call of like 10%.
Yeah.
Which is a lot, but it was also fine. And then once you do a first capital call of 10%, we were able to get a line of credit. So then you can take more on the line of credit.
Totally get you. Okay, so you do the first close on 17, 18.
Yeah.
What happens then?
So then we were feeling pretty good. It was December of 2019.
Yeah.
And so we're like, all right, we're gonna do a second close. We decided March of 2020.
Okay.
So we went out and we felt like we had a bunch of folks committed. We did one road trip. We went out to the East Coast from San Francisco. Jake and I went out, and this was like the second week of March 2020. And so when we flew out there, things were fine. And then all of a sudden, everyone canceled all the meetings. COVID started. The NBA shut down. Everything happened. And it was basically a totally wasted trip. And we came back on a completely empty flight. There were 10 people on a flight that would hold 200 people. So it was a totally wild time. And this close that we were supposed to do in March, everyone who had already committed, including people who had signed, backed out. So we were like, shit, we don't have a fund. Or we don't have the fund that we wanted. So we
were you pissed off?
No, you can totally understand why. The world is melting. The world is falling apart. The stock market is going strictly downwards. People, I don't mind that people were like, I can't invest in your fund. I don't know how much money I have. I don't know what's going on in the world. Totally get it.
So what do you do then? You get back and you're like, shit.
Shit. So we're like, okay, at that point we were shooting for a $60 million fund. We said, you know what? We sent a letter to LPs saying, you know what? We're going to go for 30 to 40. And we said all these things that in hindsight were wrong, which is we thought valuations were going to come down, which, at the time it seemed like that was going to happen. Of course, actually the opposite happened. And so we said we're going to do a smaller fund. And then what happened was May, interest rates go down, money printer goes brr, and everyone came back. And even folks that had said no to us came back and said, hey, actually, like, we were looking at the managers that we spoke to. We'd like to talk to you again. And several of the folks that said no to us actually came back and came into the fund. And we ended up with a pretty institutional fund.
Did it get easier? Everyone's always like, oh, when you get to halfway, you know, people really get around the table.
It did get easier.
It did. At what
and so
point
our target was 60. We ended up going to 75. And even at the 75, we had to push people down from what they wanted to invest.
When did it get easier? Was there a tipping point?
I think it was when we were like over half.
Yeah.
And we got a few of these institutions in.
Do you find names helped?
I think names probably helped some of them.
Yeah.
And we have I think several of like very good fund of funds that are invested in us, and we have like a university endowment and others, and I think all of that helps.
What was the single best LP meeting?
So I would say for Fund 2, now Fund 2 we raised in December 2021. The whole process only took a month. For Fund 2, we had a bunch of folks who knew us by reputation already. They'd seen our portfolio. They'd talked to other managers about us. They knew companies in our portfolio well, like they tried to invest in them or whatever. And so there were folks who were literally just checking the box by talking to us. And in a 20-minute meeting, they were willing to commit large sums of money. So like double-digit millions because they knew us. And I get where they're coming from. Like they know us by reputation. They've spoken to other managers who sit on boards with us or whatever. Like what more do you need? You know the portfolio. It's on our website.
100%. Was there one meeting though where you were like, that was a great meeting?
I think I've had great meetings with like other folks who also invest. So there are funds that have a fund of fund strategy and a direct strategy.
Yeah.
And some of those folks just like knew our portfolio so well and they were able to speak to our portfolio. And I was like, man, these guys have done their homework.
But I think like, when I think about mine, like I think Beezer at Sapphire.
Oh, she's awesome.
But when you think about someone who truly gets the intricacies of our business to a very granular level, and it's not high level, talk to me about how you think about Fintech, like my shit questions. But like, it's really in depth and she lives and breathes your business. Like she would be one for me. I met her years before I did even 20 VC funds. But like, was there one that really stood out?
No, so she's an LP in our fund as well. And it was clear, like, so we'd met her for Fund 1. I think it wasn't a fit for her then. And then it was clear by Fund 2, like we invited her to our LP meeting and her team came and it was clear they were super interested and like they had a few questions, but they knew us.
Yeah.
And I think for some folks it just takes time. And I think part of what we talked about was it got easier as time went on and as we'd closed half the fund. But part of it is also just literally time. Like they met us and then it took 6 months of getting to know us and like they'd heard about us from their other managers and other LPs. Like the LPs have a network where they talk all the time, going to the same conferences, et cetera.
How did you instill a sense of urgency in the fundraise where it was a case of really committing to a close date and getting LPs to move in unison?
Yeah. So in Fund 1, we tried to do it and frankly it didn't work.
It's hard.
Yeah. It was really
you
hard.
also, it's really hard because you don't want to force them to a no,
Yeah.
by hey, next week. But you also don't want to say a month where it looks like you've got too much time and then they don't move to it.
Yeah. So there's no easy way. I think you give them a date and then odds are they're going to be like, okay, like I know that date doesn't matter because if I want to invest, I'm going to be able to invest. And so that's what happened in Fund 1. It took a while. So it took us about a year from start to finish. And Fund 2 was very different because there really was like much more demand for our fund than we had space. So it really was, we told our LPs, our existing LPs, Fund 1 LPs, commit to us by this date. And all of them came back and committed by that date. And we were actually kind of surprised because...
By them sizing up.
Yeah. We didn't know that was going to happen. And it actually caught us by surprise and kind of like screwed us up a little bit in some ways.
How so?
We had intended on running a process and we'd spoken to a bunch of LPs and actually told these LPs, like, you have plenty of time. Like, and, you know, for some LPs, like university endowments, it just takes time. It takes a few months. Like, they have a different IC process. And we told them, like, yeah, we're meeting now, but don't worry, we're going to raise in Q1. And, you know, you can commit to us by March. And then what ended up happening was we closed everything in December. And we did it all pretty quickly. I think part of it was, you know, frankly, December 2021 was a good time to raise a fund. Yep. And so we ended up closing pretty quickly. And some of these folks that we actually would really like to have in our fund, some like university endowments that we have a great relationship with. And we just like, we told them that they had more time than they did. So that didn't really work out.
How would you advise managers on capital concentration on a per LP basis?
So all of our LPs are 10% or less of our fund. And it makes us feel good now in a market where if any one LP doesn't come into our next fund because, you know, circumstances changed, it's fine for us. We have other folks who want to fill those gaps.
Totally with you there. In terms of like...
Now, that being said, like if somebody had come in and said, I want to do 40% of your fund, then, you know, in fund one, I probably would have said yes. Like we needed the capital. In fund two, we could be more choosy. We actually pushed folks down to the 10%. So some folks had wanted to do larger checks and we pushed them down.
Do you have an LPAC?
We do, yeah.
Who's on the LPAC?
We have five of our like biggest investors. They're one family office, and then the others are fund of funds. And I would say we don't use it that much. We use it for like conflicts, or we launched this accelerator recently, the Mint. Uh-huh. And when we launched the accelerator, we said, hey, we should get their approval. And so we talked to them.
Why did you launch an accelerator? This seems like the worst time to do an accelerator, respectfully.
I think it's the best time to do an accelerator. So,
but you've seen the unbundling of accelerators with YC. Yeah, I think like a year ago, everyone was like, "Oh, YC is losing power," and then kind of Gary Tan came back and said, "Fuck you" to everyone.
Yeah.
And then also kind of got a little bit moody on social. He told me, have fun staying poor. I responded, I'm in Belgravia. But you do you. But, like, you know, when we saw this unbundling, you've got your Neo of the world with Ali Partovi.
Yeah.
And you've just got a lot of, you know, obviously Josh did Hyper from Product Hunt, and you've seen a lot of them. Why was now a good time?
Yeah. So, number one, I ran an accelerator from 2016 to 2018.
Yeah.
And that fund has incredible performance. And I think more important than that, founders that we backed back then in the accelerator said, hey, my friends are starting a company. What's the closest thing to what we had, which was in person, super hands-on. So we had experts in growth, marketing, recruiting available to them. And the answer was there's nothing like it. YC is a totally different beast. YC is great. Like they have great companies, but it's really built for scale. And some of our portfolio companies that went through YC said they didn't really get the support in fintech that they needed. They have like a generalist mentor who doesn't know anything about fintech. And so they would be asking these questions and they had no idea what to do. So we felt like, there's an opportunity here. Like once again, people are asking for a fintech solution and we can give them that.
Okay, and so you decide to give them that. What are the next steps look like? How do you fund an accelerator or an incubator?
Yeah, so ours is, we'll probably have about 10 companies in this. We're thinking 6 to 10, and we're investing $500,000 in every company. So it's actually, for a fund like ours, it's not that much money.
No, it's a great, but like you actually have to fund the incubator, like the holding company behind it.
It's not a holding company. In our case, it's just a carve out of the fund into a separate vehicle.
Do you not have to pay the mentors?
We do. We pay it all out of our management fees. So really what's happening...
That's a lot, isn't it?
It's a lot. So really what's happening is it's a great deal for LPs because we are getting a better deal on the investments because we're taking money out of our management fees and paying for new space and mentors and all this other stuff.
But like, can you run that for less than $1.5 million a year?
Yeah, you can.
You can?
We're doing a lot of it ourselves, and I think we've got great mentors that we're really excited about, and we can do it all for less.
What's the hardest thing about doing an incubator?
It takes a lot of time. Just there's a lot of like operational setup, and then the way to make it successful. And I think the reason why people liked it so much when we did it in 16 to 18 was it just takes a lot of your time. You need to be fully committed, like 24 hours to this group of people. We have all these companies flying into San Francisco. JC's our guy who's running it, JC on our team, and Lauren. And like they're going to be fully committed to making sure these guys have a great experience. And it's from everything from like being a social guide to San Francisco to finding the best mentors for a particular company. And like you have a need, I'm going to go out and search for somebody who can help you with that need. And I think just by being fully committed is how you have success.
I totally get you. Can I ask, is there an adverse selection case here, which is like you get a better deal, 500K for each company?
Yeah.
The best companies are raising at 15 to 20 when they're spin-outs from great companies, or even actually just generally they're raising at 15 to 20. I find.
Yeah. So I'll tell you, in 2016 to 2018, I did it, 5 cohorts. I was investing in a $2.5 million valuation then.
Oh my God.
And I have
500K gets you 20%.
But we're doing 500K for 10% in our company.
Sure, but I'm saying just in that time, like that is nuts.
And we have 5 companies that are more than 70x on so we did 5 cohorts of 6 to 10 companies, and out of all those, so say it's like 40 companies in total, we have 5 companies that are delivering more than 70x return.
Are they DPI?
We have DPI. We have returned the full fund.
How do you think about DPI? Again, I've spent some time with different LPs over the last few days, and they're like, any manager who had the chance to return DPI and didn't over the last few years, you're in trouble.
I think that's right. I think you had to see the market and say, we should sell here. So we did in some cases. Now, of course, we didn't sell nearly enough. Like we should have. Yeah. We should have sold more, and we had opportunities to, and we didn't.
But you did sell.
We did sell. Yeah.
How do you advise on selling, in terms of take it 30% off the table, and just protect your initial position, but ride the upside, take the majority off, take all off? What are your thoughts?
I generally think, in one case, we sold our entire position to a later stage investor, but that's unusual for us. I think generally speaking, we'd like to just ease our position, and if you can return an entire fund, there's something about having 1x DPI that's quite nice.
Yeah.
So like if you can get to a point where you can return 1x DPI and still have upside in a company, that's great. Yeah. Ideally, like if you're still excited about the company, then you want to keep half of your capital or half of your equity still in the company.
What would you say is your single biggest investing mistake? A lot of people will say like not taking cash off when they really could have done last year with theirs. What would you say? Mine was the foray into emerging markets, honestly.
Yeah. For me, it was not taking enough cash out. So like I had the opportunity to take a lot. I could have returned multiples on the fund, and I didn't. And
why did you not?
So there's one company I'm thinking of that could have returned multiples on the fund. And in between when I had started to discuss taking money off the table, and when we had finally like the documents, it took like a few months. And during that time, this company grew so much, and they were like, you know what? I wouldn't sell at that price. They told me, they were like, we'll get this through for you, but I wouldn't sell at that price given how much we've increased in value. And they were like, we'll probably do another round in the next couple months. You might want to wait. So I talked to the founders, and they were like, you might want to wait. We might be worth double what you're selling at. And so I did that. And then of course they never were able to. This is beginning of 2022. The market started tanking, and they were never able to get that round done that they thought would be a double.
Do you find it difficult? It's quite a tough conversation. Hey, I love you. I want to sell my whole position in your company.
Yeah. I actually didn't find it. We haven't found it difficult in the selling. We said like we want to start. We're at a point where like we've invested for so many years in this company. We want to start reducing our position, and founders get it. It's not a big deal, especially back then when there was way too much demand for every round of the company.
Okay, so that's your mistake. When you look back over the last 24 months, what's the biggest mistake you've seen other investors make in the industry?
Well, I mean, obviously the same, and maybe going too deep into emerging markets, like you said. But other stuff, I think people can get too excited about an idea and invest behind the wrong founder. just in that idea. And in our case, let's say banking as a service. We talked about Unit. So Unit's a banking as a service company. If you want to create a debit card product within your company, you can work with Unit. So like if you're Toast, which is a point of sale system for restaurants, and you want to add more and more products, so they've added a payroll product, they can add a bank account product. And if you are the operating system for that restaurant owner, you might want to also be where they bank. And Unit offers you that opportunity. So Unit is a company in this space. I think widely considered to be a very strong company. A lot of folks looked at that company and said, we love this company, but they couldn't invest. And they ended up investing in another company in the same space. And that was just a mistake. Like, invest in the best company, not in the number 2 or number 3. And a lot of those have shaken out to not work out that well.
Founder, product, market. How do you weigh them up?
So we invest at super early stages. It's all about the founder. And you disagree.
I think it depends where you invest. But like, I think I was explaining it actually the other day to someone. I said, listen, it's very much like surfing. You need a great surfer for sure. But if they go in the middle of the night to the beach, they ain't surfing. Or if they go perfect midday, perfect, nice wind, wrong beach, they ain't surfing either. You need market timing. You need the right
but if
beach.
you invest in the surfer, if you get behind that surfer, they can switch.
They rarely do.
No,
they rarely
do. So listen,
do. And
three of my top 5 companies were pivots.
Oh, great, but there's a lot of investments in there. Like the company set that we're looking at, it's like many. And I think absolutely they can. They also need long enough runway to pivot within that. Quite often I see it where it's like actually they realize the pivot and then it gets that, we've got 6 months left. We're pivoting now.
Yeah, so you have to, it has to happen early. So if you invest super early at pre-seed, I think it makes sense to invest in the best founders in going after a market space that you
100%. I'm with you there, totally. I think it's when it's like, actually at the A, B.
Oh, at the A, it doesn't make any sense at all. Yeah. At the A, there has to be a big market that you're going after.
I would much rather.
But I'm a pre-seed seed investor, right? So
I'm also just like, so few people get to product market fit. Like when you actually determine true product market fit, don't try and get cute on founder assessment. Do you know what I mean?
Yeah.
It's really fucking hard. If they've got there, you're probably underestimating them.
It's true. I think that's once you get to product market fit.
Totally.
And we're almost exclusively investing before then.
I had a guest on the show the other day, and they said there's an inverse correlation between a founder's ability to sell the vision, sell to customers, whatever, and then their ability to operate and build.
Yeah. I don't think that's exactly true. I think there are founders who can do both. But many of our top ones, like, they had a competitor that was raising more and more money than they were. And then in the end, that competitor tanked. And our like build guy who like never was a great fundraiser ended up doing well.
Yeah. I think you see that often actually.
One thing about this like founder versus market, there's a Warren Buffett quote that everybody likes to reference, which is, you know, when a great founder meets a bad market, the market wins, and so on. So he says that. But one of my favorite stories is, do you know Mrs. B?
Yeah.
Rose Blumkin?
Yeah.
So there was this woman who came over from Belarus.
This is one that doesn't speak a word of English.
Doesn't speak English when she comes over. She starts a furniture store in Nebraska, Omaha. Originally in their basement, then it grows and grows and grows. And she's just like incredible. She didn't even go to school. She never even went to kindergarten. But she's just got such a mind for business that she continues to grow this thing incredibly. He eventually buys it in like 1983 for like, he buys 90% of it for like $60 million or something. It was actually the largest acquisition that Berkshire had made at that point. And
did she not die like 2 years after?
No,
she gave up or something. I remember he made a joke.
Okay,
like,
so what happens? So what happens is her kids end up kind of pushing her out of the business. She's 95 years old at this point.
Oh, fair enough. Yeah.
So they're like, hey, and actually what's really funny is they had an issue. They pushed her out of the business in part because they were fighting over the control of the carpet department. She said, I never want to let go of the carpet department. That's going to be my thing still. And they were like, no, you should get out of here. And they pushed her out, her kids. And then what she does is 6 months later, she opens a place across the street from them, literally a furniture store competing with them across the street. It's a spite store, basically. It's called Mrs. B's Furniture Clearance Market or something like that, across the street from the Nebraska Furniture Mart. And then eventually Warren Buffett has to buy that one too. And then he puts a clause in there he puts a non-compete clause in there that she, at whatever, 96 years old, is not going to compete with him again.
And so your point is her...
And what he said about her was, he said, I would back her in anything she did. Any business she wanted to go into, she would be successful. And so it's actually a counter. Like, it's a great founder. She would be successful at anything she did.
Have you ever had a really not good founder win?
Yes. But it was an interim win. It was like a too early win. And I think...
What does that mean? Like they sell for 50 million style, which is a great outcome.
Can be a good outcome. I've seen in my angel portfolio a founder that I thought was just okay, ended up getting to an exit. And I think if they'd continued on in the business, it wouldn't have been that successful. And that happens all the time. Like you have companies that are successful up to a certain point. The worst company gets an acquisition. The better company sticks around, and then they go public and then totally tank. It's happened many times in the past few years.
Yeah, no, I totally get you. What are the biggest reasons for you why great founders fail?
I think failing to find, first of all, like you can fail to find product market fit even if you're a great founder, and you can get stuck behind your idea, not pivot early enough. Yeah. I think you have to come to a point, and this is actually where VCs, I think, actually can be very value add, is say, hey, I think we should think about a different business and like come to make a plan. So actually I have this going on with one of my portfolio companies now. We have a plan, and if we don't get to that plan in the next 2 months, we're going to think about a different company. We're going to pivot. We have years of runway, but the current thing, it's working a little bit. There's signs that it's working, but we worry that even if it's working, it's not going to get to a huge business. So like we're going to test this out for a few months, and we're staying close on it as investors. And if it doesn't work, we're going to pivot.
Do you worry about the length of runway some companies have? I have some companies, and they're like, they've got like 60 months.
Yeah.
And it's like, honest urgency is not that, and I don't blame them at all. But like, do you worry about that? And what happens to them?
I think great founders, so I think bad founders raise a ton of money and spend it. Great founders raise a ton of money and still have the same sense of urgency, still are on the same roadmap as if they'd raised a much smaller round.
So I say always on Twitter, and it leads to so much hate, and it's probably why Andreessen hate me.
I didn't know that.
Yeah, whatever. But like, 5 on 25, I think has destroyed much of the seed industry.
Totally.
But everyone goes, well, if you get great founders, they'll raise 5 on 25 and spend like they have 2. And I'm like,
it's so rare.
Lovely idea. I love it. Yeah, you're right. And if you do that, then I promise you're right.
Yeah.
Maybe seen it once.
It's actually almost impossible, because what happens is if you raise 5, the expectations people have for salaries are different than if you raise 2.
100%.
So it's basically impossible to have the same mentality as if you raise 2.
Absolutely.
And I think I agree with you completely. The 5 on 25, like raising big rounds makes people cushy. You end up attracting people with salaries that like actually they could have gone into a big company, and actually they belong at a big company.
Yeah, they do not belong in your
They
startup.
do not belong at a hard-working, scrappy startup. And so I completely agree with you.
Okay, good. Do we see them continue? Or do they go back? We can always see multi-stage come in and out of seed.
Yeah.
Are they here to stay?
I think a lot of the multi-stage stuff is quite dumb. Like a lot of these folks have invested, they're giving like $1 million checks to kind of a lot of folks, and letting their junior team invest $1 million checks in anyone.
It's a learning check.
It's a learning check. But what happens, and I've already seen this, is my portfolio company that is working is raising a Series A or Series B. They don't want to talk to that investor because that investor invested $1 million in their competitor. That competitor is almost dead anyway. But they're like, fuck them. I'm not going to talk to that guy. They invested $1 million in my competitor. And so they missed the opportunity to invest $100 million in a great company that is winning the category because they invested $1 million in their competitor. And so I just don't think it makes sense for a multi-stage fund to do it, especially in a category where like there are multiple competitors. Why would you invest when you know that like you might have invested in the wrong one and that prevent you from investing in the good one?
I totally agree with you. When you think about the multi-stage strategies coming into seed, who do you think's done it the best?
I can't think of any multi-stage fund that I feel like has done a great job at seed.
I always think Founders Fund are pretty good at seed, actually.
I think I don't know their portfolio well enough in fintech to say that. They do a lot of seeds and they have had good success. I think my friends at Excel have done a pretty good job as well. I think
Dan Levine is good at seed.
Yeah, there's a bunch of folks who are good at seed. I think it's more individual based.
Yeah.
I think the folks that have done the spray and pray approach is very bad.
Yeah.
And people go in and out of it. So like Andreessen did a lot of it early on in Andreessen Horowitz's tenure as a fund. And then they stopped doing it and they started doing it again. And I would guess they stopped doing it now.
Yeah. I don't think they will, but we can have a debate on that one. We've seen also like large seed funds. Like I think True Ventures' seed fund was 700 million.
Yeah.
Maybe split across some, but
I think it's half and half. I think
but
it's
still like 400, 500. The
it's
initialized
huge.
is 500.
Yeah, I think these are
I'm
too
not
big.
throwing shade on it. Are they too big?
I think they're too big. I think they're both doing what I would call Series A's as well. Like they are writing $10 million checks.
Okay.
So, and I don't think of that as a seed round.
No, totally.
But I think it's too big. And I think to our point, like as you get bigger, you're more open to doing these 5 on 25 deals that actually aren't good for the founders either.
Sure.
And you're like, oh yeah, it doesn't matter to me. And as your fund size increases,
And actually, I need to put the dollars out
I
the
need to
door.
put the dollars out the door. Yeah, exactly.
What do you want to do with BTV? Do you want to move into the A?
No, I think we're happy where we are. We love the early stage, and that's why the Accelerator actually helps us go even earlier. And we love being there for founders at the
And
early
you don't
stages.
feel a lack of growth because like venture's a tough one actually because humans want to feel like they're progressing and growing.
Yeah.
and
we
actually
grew
venture you've got to be very patient.
Totally. So we grew, like my fund zero was 15 million, then we went to 75, and now we're 225 total. But we don't want to grow from here. Like,
And you're comfortable with that because that's like human ego anti-human ego. Like you're just going to stay there, which can be the right decision.
the ego where I want to grow is I want to have really fucking good returns.
But that takes a long time.
And it's actually the opposite. Like if I have a bigger fund, I'm not going to have as good
I
returns.
get you,
probably.
but then you have to be patient.
You have to be patient, which I think we're in a luxurious place where we can be patient.
What are the biggest like sources of tension between VCs and founders?
I think a lot of VCs, I've seen it in some of our portfolio companies, like a lot of VCs are very prescriptive on how to do things. And we try to not be that. We try to be just like the founder's friend and supportive, but not too prescriptive. I think you can get into a mistake being too prescriptive and sort of telling founders what to do rather than like recommending what to do. And I've seen that even from like good investors that I've been alongside on the board. I've had founders like call me after a board meeting saying like, hey, what the fuck was that? Like, I'm doing everything I was supposed to do. Why is this VC telling me what to do?
Do you find boards very helpful?
No. I think I want to be supportive to a founder in there when they need me. And that can happen in a board relationship, but usually that's not what happens in a board. And so I'm meeting with the founder every week or every couple weeks anyway. And the board is a totally different beast. It's like structured. I think a board can be helpful for the founders to sit back and reflect on their business once a quarter. And it's very effective for that. And then of course there's like governance things that need to happen. But
who's the single best board member you've sat on a board with?
I think there are a bunch. Like I have a board with Jeff Horing, the founder of Insight, and like he doesn't speak that much, but when he does, it's like, oh, he's absolutely right. And like I can look back a couple times about what he said. He was like absolutely right. I think we had one of my other companies. We had David Lowy, who was CMO of Google, and same thing. Didn't speak that much, but when he did, he was absolutely right. He had a story about Google, and it was really good. So those folks, I think these like wise folks who have a lot of experience. So I think their experience is right, and I think a lot of like younger guys can discount that experience, but like it's really valuable, and the same shit happens time and time again. And you realize that like them having seen it over the past 20 years is incredibly valuable.
We were talking earlier about kind of the weight that we place on, age of founders.
Yeah.
I totally agree with you. Like, I think a lot of the shit is very repeatable.
Totally.
Like we mentioned tension there between founders and VCs. Final one. What about tension between LPs and GPs?
Oh, yeah. I think a lot of GPs went a little crazy in 2021, and LPs were probably unhappy about that. I think if you do what you say you're going to do, LPs are happy. And I think we do what we say we're going to do. We talk to our
Most
LPs on a regular
GPs
basis.
didn't.
Yeah, I think a lot of GPs got out of their zone.
Yeah.
And I think that was a mistake.
Mm-hmm. So the core misalignment there is actually the incentive mechanism of deployment schedules. Like in managers' cases, it makes sense to deploy more, raise more, get more fees.
Totally.
But for LPs, that is misaligned.
Yeah. So a lot of folks had these 1-year funds. I even heard of some sub 1-year funds.
Sure.
And coming back to market, and that's not what LPs want.
But I spoke to one manager recently, and they raised they'll be on Fund 5 within 6 years.
Crazy.
Yeah. And they're like, yeah. But normally, it's like, oh, by the third fund, that's when the rubber hits the road, like 7, 8 years in. I've got 5 to 6 funds in that time. So I'm doubled on AUM before they actually know. So they have to underwrite me for the 5, 6 without knowing. Not 3 to you, Harry.
I think...
which made me really like...
Yeah, it's ick. Like, I'm in this business to have good returns. I'm investing a bunch of my net worth into these funds too. And so...
So I think the GP commits actually an area of misalignment, not alignment, in the way that a lot of them will be like, hey, we need 3%.
Yeah.
And you're like, well, shit, my fund's 140 million.
Totally.
I have not been working for years and
Yeah.
years. This is like 4 million plus.
Yeah.
Oh my God, like I'm going to have to borrow and beg and steal, not literally, but do you know what I mean? That's
Totally.
not good.
And I'll tell you what can happen if the GP commit is too high. You can be financially strapped and you can say, oh, I'm going to sell my position in this company in the Series B because I need to return that capital to myself.
Sure.
And that can be a misalignment
Or
because you're missing out on the
or
upside.
you take it out of fees, which then is not invested into the firm where it should be.
Totally.
It's like a shit show. And then also just bluntly, neither of like the above. Like we want diversity and, an amazing ecosystem. Well, good luck. Like,
Yeah. So I think that's true, but I think like the way things are, like a couple percent, 1 to 2%, like if you can't do it, I think it's probably fine. But I think I actually don't think we don't need like 100 new managers or thousands of new managers every year.
Do you
like
think
what
we'll
we
see
had.
way less now?
Yeah, it's just so hard to raise a fund now. And you have wonderful
I'm
people.
still seeing a lot raised though.
I'm seeing it too.
We're not raised, but come
Trying
to
to
me
raise.
telling me they're raising.
Same. I haven't seen much of a slowdown
No, I
there.
haven't at all.
And
A lot of operators like doing the 3 to 5 million fund, which I'm not against at all. I think
it's just a really hard business.
Yeah.
If you're running a tiny fund, it's really hard. And I don't think many of these folks are going to continue on. Like their fund 2, fund 3s are going to be really tough.
Oh my God, yeah, because it's all GPs who are in it, GPs and founders.
Yeah.
Final one, I promise. What do you think of like founders who have funds on the side?
I think some people have done it well, but I think there are founders who have funds on the side who like lead deals. And that is crazy to me. If you think about like, especially now when we have a bunch of companies that are struggling, we had the SVB crisis, like you need to be there for your founders. And if you're there for your founders, you're not there for your company. And that is a problem. So I think founders with like investing checks on the side occasionally is fine, or if it's strategic, it's fine. But I think there are founders who are like leading rounds, and I think that's bonkers. If you think about like, we have a company going through some shit right now, and I'm there for them any time of the day or night. And if I was running my own company and this wasn't all I was doing, like I wouldn't be able to do that. And I don't know how you square that. Like how can you be operating a fund and running a company? What do you think?
So I totally get you. I think that Jack Altman's done it incredibly well.
Yeah.
And I don't know how this guy does it. He's got a father. He runs Lattice. I mean, so he does it. And
But he doesn't lead rounds. He's writing checks
does
into
now.
round.
He does now.
And he's what? He does?
He does now.
Oh, okay. I didn't know.
So he does now. For me, and again, I think the biggest challenge that I just struggle to get over, and I'm not throwing shade, but I struggle to get over it, which is like when you take external capital, that is an incredible responsibility.
Totally.
And when you take external capital for a second thing on top of something that you've already raised significant millions of dollars for the first one, if I'm in the first one, I'm like, that is disrespectful to my money. Like, I gave you money to do this, and that's like I'm thrilled to do it, but like, do what you said you were going to do.
Totally. Yeah.
And so I don't have a problem with founders angel investing.
No, I don't at all.
Rock and roll.
Yeah.
But when you're raising...
another thing is like...
LP
a lot of
management,
folks
by
do
the
it.
way.
What?
LP management. Like,
yeah.
Suddenly you have 50 LPs in your...
I just think about how, like, I am doing this job, like, round the clock, and I just can't imagine having another full-time job.
I totally agree. Final one. Your wedding was like... it was in the Metaverse?
Yeah.
How did that go?
Okay. So it was in the Taco Bell Metaverse. It was an Indian wedding in this Taco Bell in the Metaverse. And you're like, why the fuck would you do that? And credit to my wife, Amrita, because she went along with all this crazy shit. You know me. I say yes to a lot of stupid stuff. And this was just another one in a long line of those examples. And in this case, Taco Bell had a contest about getting married in the Taco Bell Metaverse. And I'm a fan of Taco Bell. People on my Twitter know that. So when they came out with this, a lot of folks tagged me. They were like, Sheel, this is for you. They saw that I just gotten engaged, and they were like, this is perfect for you. You should do it. And so I was with my wife, my now wife, driving on a road trip. And I mentioned to her, I was like, hey, look at this. Just like casually, like, hey, look at this. Wouldn't it be fun? And to my surprise, she said, yeah, all right, let's make the video. It'd be fun. It'd be like a fun exercise. So we took 20 minutes and thought about what we would say, and we stopped and recorded it. We actually only did we only recorded it twice. We didn't think that much about it because we just thought it's a fun thing to do, but we're probably not going to actually submit it. And if we submit it, we're not going to win. And if we win, we're not going to do it. So, what happens? We get back from the trip, and I'm just like, let me just submit it, whatever. And then we get notified by Taco Bell that we've won. And then we kind of pushed back and said, hey, like, I don't know if this is for us. We don't want to get married in this Taco Bell Metaverse. And then they were like, hey, just get on a Zoom call with us. So we got on a Zoom call with them, and they convince us. They say, it's going to be your wedding. We're going to do whatever you want. It can be Indian. We'll design it for you. And you're going to be part of the Taco Bell family. They said, you're going to be part of the Taco Bell family. And I was like, that's what I've always wanted. So we eventually did it. And it was really fun. It was in February.
What does it mean? So you sit in a room on Zoom?
So you're sitting in a room with some of our friends were there too. And we're on camera. And there's this metaverse. It's in Decentraland. It was actually really cool. For a while, I was pretty skeptical about it. I've never spent any time in the metaverse. Yeah. I'm not like a metaverse guy. But it was actually really, really cool. I rode it on an elephant. People from around the world were there. My family in India was attending. They have their avatars. It was actually really cool. It sounds really stupid. Actually, the day of, I was thinking this is cool.
And you say your vows through it?
Said our vows through it. Did everything. It was a legal wedding. We were legally married in this metaverse.
Was it quite emotional?
It was very emotional, yeah.
Yeah.
It was fun.
Did your wife like it?
Yeah, she loved it.
Do you get like Taco Bell credits?
We do. We do. We have a lot of Taco Bell credits.
How many credits do you get?
I don't know. They gave me $500 for my birthday in Taco Bell credits, which actually Taco Bell gets you pretty far. They also paid for our honeymoon, $25K, which is pretty nice.
Yeah.
And they've been great.
What's your favorite thing from Taco Bell? Like, we've just had Taco Bell like land in the UK.
Oh yeah.
I've never
Mexican
been.
pizza, big fan.
Mexican pizza.
It's amazing. Yeah, you'll love it.
This is a pizza.
Mexican food in the UK sucks, I have to say.
Oh, terrible. We don't have anywhere.
Yeah.
Have anywhere. We've got La Bodega Negra, which is like nicer, higher end. We've got Oaxaca on the lower end.
Oh yeah.
Shit. No, I always wanted to do
Taco Bell. Taco Bell's great.
Me and my girlfriend bonded because we both wanted to open a Mexican restaurant.
Oh, amazing. It would do well.
And neither of us have done it.
Yeah. But anyway, it's not our only wedding. We both are married and are still planning multiple more weddings. Me and the same woman, to be clear. So we did this Taco Bell one. We did an India reception. We're doing Cleveland, where she's from, Pittsburgh, where I'm from, and then a big one in Mexico City. That'll be our friends.
I mean,
So,
that is amazing. I saw this and I was like, what the fuck has he got
It's
into
crazy,
now?
yeah, but it's fun.
Listen, I want to do a quick fire round. So I say a short statement, you give me your immediate thoughts, okay? What one seed firm other than BTV would you invest in?
I think the best ones have now retired, and only they're investing their own money. So that's Homebrew and IA.
I definitely agree with you there. Founder Collective as well are very, very good.
Oh yeah, super good.
Yeah. What Series A firm would you most invest in?
I can think of so many good ones. We've invested a lot with Excel, and I think they do a really good job. But I guess in the spirit of keeping fund size small, it's hard to beat Benchmark.
I have to say I'd choose Benchmark at the A.
Yeah.
You can do a multi-stage firm now. We're going kind of growth / multi-stage. Who would you go for?
Yeah. Again, I worry about this fund size increase. So because Founders Fund shrunk their fund size, I'm going to go with Founders Fund.
It's not a bad shout. Green Oats I really like.
Yeah.
I really like Edition.
Yeah. All good.
Really
good
like
folks.
Ribbit.
Yeah, they're all good.
It's tough actually, but they're all big funds.
Big funds.
What have you changed your mind on in the last 12 months? Getting married in the Metaverse.
Getting married in the Metaverse. I think, we talked about secondary a bunch. I think I'm much more likely to take some chips off the table earlier than I was before.
What do you advise founders on taking secondary?
My rule that I like to live by is at the Series B and beyond, you can take as much secondary as you have in ARR.
Wow. That's a good one. I haven't heard that one before.
Just think about it. It makes sense, right? Like if you're building a real business, I don't mind if you take chips off the table, but you've got to be building a real business.
But so I totally get you. But do you blame the founders who took off a lot of money?
No, a lot of times it was VCs pressuring them to do it,
and they're getting so much hate now from the media. And it's
they shouldn't get hate. I don't hate the founders at all for doing it.
Yeah.
But I think if you did an index of companies where founders took, a lot more than that, what I described, like 1x ARR off the table, you have a very negative returning fund.
Yeah, I agree. What would you most like to change about the world of venture?
I think fewer douchebags who think they know it all. I think there's a lot of insecure folks who just put down other people. We don't need that.
What do you see that you don't think enough people are spending time on?
Man, tough question. What do I see that other people haven't seen?
So I find that a lot of the multi-stage firms are not calling capital actually now. Why? Because actually they had to increase their GP commit so much to get the fund sizes that they wanted that every time they call capital, they're on the hook for $10 or $15 million from the GPs. On top of that, they actually raised debt on the high levels of 2021, and then they committed to 50 other funds, and so they're personally up
on the hook for a lot, and they're trying to sell their LP positions.
Yeah, but no one is looking at that.
Yeah, it's true. That's happening. I think there's this overhang of valuations, and we haven't yet seen the drop that is going to come, and it's going to be so severe. And all these growth round investors that had companies go IPO and then fall, they haven't made any investments. I think what we're not seeing in some of these companies that have raised more money is just the immense amount of structure that's going into them.
What happens to Tiger and SoftBank?
Tiger, I think so. They recently led a Series A of one of our portfolio companies, and they actually, in contrast to their investments in 2021, which I think John Curtius and others were writing a lot of checks, and sometimes very quickly. This one, they led our Series A. They did a ton of work, and they've actually been super helpful to the company. It's a very different Tiger than the one of 2021. And I think they're doing a really good job now. And I think it's going to be a much smaller fund. And like you said, it's going to be a ton of their own GP money. Yeah. But I'm excited about them. I think they're good actors.
Is there a return for SoftBank?
SoftBank, I think, is just really tough. They made just a ton of incredibly poor decisions, poured a ton of money into bad companies. And they really sort of we talked about 5 on 25. For them, it's more 500 on 2.5 for a company that was nowhere near ready to accept that kind of money.
That's unfair. I thought WAG was a brilliant dog on demand company.
What about Zoom, the pizza company?
Oh, this was exactly. I was surprised to see that one go bust.
Of course, they needed $300 million from SoftBank.
You looked at that and you're like, wasn't a surprise, was it?
No, like literally from day one. So, okay, on that company, I met a guy who invested in that company early, or relatively early, and it was a data-driven VC. And I was like, what data do you have for this company? And he was like, we have all this data on like number of shares on Facebook of this video about them. And I was like, why the fuck would you invest off of a shares on Facebook shares on a pizza company? Like people were sharing this video about this pizza company on Zoom because it's like a robotic pizza company, and they used that as input to invest. And I was like, that's crazy.
And then they told SoftBank about that one, and they heard you're investing. They didn't even hear the shares. They're like, done, boom. Final one, my friend. BTV in 5 years' time. Where do you want to be then?
I think we want to be cemented our reputation as the first choice of founders building a fintech company globally.
My friend, I've loved it. It's so much nicer to do it in person.
So
Thank
great.
you so much for coming, and I've loved it.
So fun. Loved it.
You're the man.